hike as of now, as we can see on the CME FedWatch chart. And here's some of what Warsh had to say about whether he sees progress on the fight against inflation.
Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress over the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth, but in my view, in tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time.
And now for a look at how U.S. stocks are performing at this noon hour. Let's start out with a look at the Dow Industrials. Right now, we are looking at the Dow holding on to gains higher by a little over 0.1% and up by about 77 points. As for the Nasdaq Composite Index, we are looking at a pullback of about 0.3%, while the S&P 500 is trending right below the flat line. As for the Russell 2000, we are looking at the Russell lower by a little over 1%, and the NYC Composite Index is also in negative territory, pulling back by a little over 40 points, or about minus 0.2%. As for other areas of the market at this noon hour, we are keeping a close eye on Treasury yields. Right now, we are looking at the 10-year hovering right around the 4.7% level. As for long-term yields, let's take a look at the 30-year chart at this noon hour. We're looking at the 30-year currently hovering right around flat, but still does remain elevated right at the 5.19% level. As for commodities, we are looking at oil pulling back, looking at the WTI contract, the front month contract for WTI. We're looking at it holding right above the $83 a barrel level and pulling back a little over half a percentage point. As for the FX markets, let's start out by looking at the dollar index. We are looking at the dollar index currently hovering right around the 99.50 level. As for crypto, we are looking at crypto majors, Bitcoin and ETH sliding. Right now, we're looking at Bitcoin pulling back, and it is currently holding on to 77,970 and down a little over 2.8%. Meanwhile, taking a look at ETH this morning, we are looking at a pullback with ETH currently hovering right around the 2450 level and down about 2%. And ahead of the weekend, economic data points have been coming out this morning. The University of Michigan's Consumer Sentiment Index taking a hit, falling in August for the first time in 3 months. Now, the University of Michigan's Consumer Sentiment Index dropping to 51.7, and this did come as households continue to feel the squeeze from the ongoing Middle East conflict and elevated day-to-day costs, with gas prices holding above $4 a gallon. Meanwhile, according to BLS data, U.S. job growth actually weaker than initially reported. Now, new government data showing payrolls will likely be revised down by 79,000 jobs in the year through March, and that does bring the average monthly job growth down to just 11,000. This downward revision highlighting a cooling trend that prompted the Fed Reserve to cut rates in 2025 despite sticky inflation. And now for a quick look at stocks moving markets. Today, we are looking at Gap shares surging as the company names a new CEO for its Old Navy brand. Chief Customer Officer Michael Francis will take over the Old Navy CEO role effective November 2nd of this year. And this does come as the retailer tries to combat sluggish sales. Now, Old Navy sales dropped 4% year over year, with comp sales also dropping 4% in the latest quarter. Gap did post a Q2 double beat and is raising its full year outlook. And while it is lunchtime here in New York, it is 11 a.m. in Chicago over at the CBOE. So let's head on over to the CBOE trading floor following Warsh's Jackson Hole debut this morning. FinTech TV correspondent Errol Coleman is standing by. So good afternoon. I understand it's still the morning over there, but first and foremost, get us caught up on the trading action over at CBOE, especially following Warsh's speech this morning, Errol.
Yeah, absolutely. It's been pretty loud and pretty volatile over here, especially after Warsh's speech. And the Fed is obviously one of the big ones today, and we're seeing prediction markets react in real time to Warsh, just like the bond market is. But what's interesting, Remy, is the amount of participation The September Fed decision market on Kalshi has already traded more than 15 million in volume. And for traders, I think these markets are becoming another useful sentiment tool, right? I wouldn't treat the probabilities as gospel, but they give you a really quick look at what the crowd is pricing around the Fed. Inflation, energy, crypto, and even individual events like our Jackson Hole events today. So it's been very volatile. And it looks like it's been a little bit of a risk-on, risk-off sentiment. So the market's been all over the place, and it's pretty loud out here on the CBOE floor right now, Remy.
Yeah, and while we have you here, Errol, as you mentioned, there's been a lot of volatility this morning after Warsh spoke in Jackson Hole. And of course, as you and I were talking earlier this morning, there's been a lot of anticipation heading into Warsh's speech. But tell us what you're seeing in terms of the VIX right now.
Right now, the market's been on its head, it's been on its butt right now, but VIX is trading fairly low right now, getting down to a low at around 1450, which is making new lows for the week on volatility. And that really says something there, Remy, because volatility was already low. So to see the VIX drop even lower to a new week's low after Warsh made his comments is pretty surprising. That entire move has been reversed right now, so volatility is back up on bid just a little bit. But volatility still remaining low. It seems there doesn't seem to be too much fear pouring into this market right now. Traders and investors are fairly comfortable, you could say.
Well, Errol, appreciate your time. Thank you so much for weighing in and joining us all the way from Chicago. Have a great weekend.
Still to come, Chief Economist Brian Jacobson breaks down the Treasury's move to double long-term bond buybacks.
Welcome back to Market Movers Midday. Well, bond yields are moving in real time after Fed Chair Kevin Warsh delivered a decisive hawkish address at Jackson Hole. And he did dedicate the Fed to its firm 2% inflation target. Now, short-term yields surging as traders quickly price in around a 60% chance of a rate hike at the September 16th FOMC meeting. Well, joining us live to break down the yield curve and what we're seeing across all asset classes is Brian Jacobson, Chief Economic Strategist for Annex Wealth Management. Brian, good afternoon. Thank you so much for joining us. So there's a lot of anticipation heading into the symposium, and I do want to get your perspective on what we're seeing across markets, in particular with the bond market. What is it telling us about Fed credibility versus long-term economic growth?
Yeah, thank you for having me. I think that he actually did a really good job of trying to reestablish some of the credibility, because with his previous press conference, he, I think, did a little bit of damage to the Fed and whether or not it's actually committed to a 2% inflation target, whether or not they're going to pick and choose which inflation measure they like. And so I thought it was really important that he came out and said that that 2% as measured by the personal consumption expenditure deflator, which is a mouthful, but that is the one that they've been using officially since 2012. So I thought that was a really important move. And then when we got towards the end of the speech, when he was talking about more, he wasn't giving us forward guidance, right? But he was at least giving us a feel for how he's looking at where we are right now and whether rates, that overnight interest rate, is actually restrictive. And so I think that the real message in terms of trying to predict what policy moves might come is that he is open to hiking rates in September, but he doesn't want to commit to it because who knows what the data may be between now and then.
Yeah, and in addition to the symposium, we did get that BLS revision as well. And as you highlighted, Warsh did weigh in on wage inflation concerns, as well as the current Fed policy and restrictions. So do you agree with what Warsh said? And do you think the Fed is potentially at risk of over tightening into a cooling economy?
Well, I think that that is a risk, and that's why I think he wants to tread very carefully, that if they do a hike, it could be kind of like what the European Central Bank did, which was do a one and done. So they hike, and then they can see how things play out, because when it comes down to it, the 0.25 percentage point move that they might have in that overnight federal funds rate market isn't really going to affect you and me or most businesses really all that much. And it's really about those longer term rates, the 10-year treasury, the 30-year treasury. It's those rates. And so perhaps what we've seen in the past is when the Fed actually hikes on the short end, it can lower those rates if it helps contain people's inflation expectations going forward. It is a bit of a gamble, because if we think about what's been driving the economy so far, it's been capital expenditures and manufacturing. Those are the parts of the economy that are more sensitive to rate hikes. So it's very different than what we had for the past few years, and in fact, the past few decades, where growth was mostly driven by consumers and services. Now it's CapEx and manufacturing. And that probably calls for a little bit more caution when it comes to breaking out a rate hike to try to deal with inflation.
Yeah, and Brian, while I have you here, I've been trying to keep a close eye on what's happening across asset classes, including equities as well as treasury yields. And it does look as though the Dow is barely holding on to session gains. So there's been a lot of volatility after Warsh's speech. But where should investors out there be in terms of exposure when it comes to cash and fixed income, especially ahead of the September meeting?
Yeah, I think that actually personally, the way that we're managing portfolios is to look at bonds. The move up that we've seen in yields can present some interesting income opportunities. And if the Fed does indeed hike, we could see a rally on the long end of that curve, but it's probably going to be short-lived, because we're still not dealing with the fundamental problems of 6% deficits relative to gross domestic product, $40 trillion in debt. And so I would be playing it a bit more tactically, a little bit biased towards fixed income, making a play on the longer end. But within the equities, don't count them out, but look at more like industrials, look at small caps, mid caps, basically the parts that have been working pretty well so far this year. I would say stick with it. Don't make any radical changes.
Yeah, and Brian, I'm so glad you're joining us today. You joined us earlier this week, but here we are post Kevin Warsh's symposium speech. And next week we get the August jobs report. In addition to that employment figure at the end of the week, ahead of that Labor Day holiday weekend, we get JOLTS, ADP. We also get ISM Manufacturing and Services, and also Broadcom is on tap in terms of earnings. So how are you planning to head into the full trading week next week?
Yeah, so next week, what we're really doing in terms of preparing for it is thinking that it is the first week of the month. So that ISM manufacturing number, I think that's going to be really critical, especially looking at the employment subindex. It has shown improvement. If it shows any sign of pulling back, that could be a harbinger of a weak number for on Friday with the Bureau of Labor Statistics employment report. But my expectation is we're going to see that continue to improve. And then that could set the stage for actually maybe a little bit of relief in terms of the slowdown, the sluggishness that we've seen during the summertime with hiring, perhaps a reacceleration, but then it does light a fire under the Fed to give them the go-ahead to probably hike in September. So I guess it's not going to be a sleepy, snoozy summer, or at least an end to it here.
Yeah, and finally, before I let you go, as we were talking, we saw the Dow Industrials dip below the flat line, and we are looking at the 10-year climbing yet once again above that 4.72% level. So as you mentioned, we are edging closer to the end of summer. So what is the biggest catalyst or catalyst that you think really matters for the markets as we head into the final weeks of Q3?
Yeah, I think that for the final weeks of Q3, we really do need to focus on next week being very critical. The Institute of Supply Management Manufacturing Index, and they have the service one that comes out a couple days later, and then the jobs report. Because as long as those are pointing towards having some sort of support and reacceleration of growth, we might see that the yields move higher, those long end yields move higher. But if we see continued growth, that should be, I think, supportive of the broad equity markets. Now, obviously, we don't know what the data will be. My modeling suggests that we should expect those to see continued improvements. And so I think that really the key message is to have that diversified portfolio, maybe take this as an opportunity to reassess, are you over your skis in one area or another, and try to get back to that longer term target.
Well, Brian, appreciate your time. Thank you so much for joining us on this Friday. And of course, I appreciate your perspective. So thank you so much and have a great weekend.
Thank you.
Still to come, UBS Private Wealth Management's Brad Bernstein with the key market insights and a recap of Warsh's Jackson Hole presser today.
Welcome back to Market Movers Midday. Well, Wall Street is digesting a hawkish surprise from Fed Chair Kevin Warsh at Jackson Hole. Now, Warsh vowing to bring inflation back to a firm 2% target. And not surprisingly, Fed funds futures pricing in a greater than 59% chance of a rate hike at the upcoming September meeting. Well, joining us live to break down market reaction and also capital allocation strategies is Brad Bernstein, Managing Director at UBS Private Wealth Management. Brad, great to have you here. Thank you so much for joining us. Well, we are looking at the major U.S. stock averages in negative territory, and the 10-year yield is back at that 4.72% level. But first, I do want to get your perspective on what Warsh signaled when it comes to inflation. So give us your perspective, and what does this mean for the markets going forward when it comes to Fed policy?
Today we got to watch Warsh's first Jackson Hole speech. And I think he tried to communicate a little better than he did in his previous Fed meeting. But what we heard today was he's not committal to what they're going to do at the September meeting or what they're going to do the rest of the year. But he's definitely was more hawkish, focusing on the Fed's target at 2%, not in the low threes where we are today. However, that being said, we're still out of consensus at UBS. We still believe we're not going to get a rate hike this year, although the odds, as you've noted, were about 60% no hike prior to the speech to about 60% yes hike for the September meeting.
Yeah, and while you were talking, I was also monitoring what's happening with the 10-year, and we are now looking at it at 4.73. But when we're talking about the yield curve, how should investors adjust fixed income duration and cash positions right now?
We're constructive on fixed income here. We have some of the highest yields we've seen since the financial crisis in roughly 19, 20 years. So there's a lot of opportunity out there right now, especially in the tax-free, the municipal bond market. Tactically, we think the risk reward looks really attractive in the short to intermediate space in fixed income, but there's certainly opportunities across the curve right now.
Yeah, and speaking of opportunities, I do want to get your perspective on equities. So we all know that U.S. stocks are navigating rate hike bets now alongside tech momentum. So tell us what the hawkish Fed could possibly mean for the rally that we're seeing overall year to date when it comes to the equity markets. And do you think it potentially could create an entry point for clients out there?
I mean, right now we're constructive into the end of the year on the equity market, driven primarily by the tremendous, incredible earnings growth that we're experiencing this year, which is broad-based. So that being said, the data points that come out over the next week and into early September will be very, very critical for what the Fed actually does do in the mid-September meeting. That being said, even if the Fed were to potentially raise a quarter point in the September meeting, that would be in the backdrop of strong enough economic data for the Fed to feel comfortable doing it, because obviously the Fed has a dual mandate and doesn't want to create a recession or slow the economy down too much to hurt job growth. That being said, earnings are the story, and I don't think whatever the Fed does or doesn't do in September will really have a big impact for earnings results that we'll see during the next quarterly earnings season.
Yeah, and I'm glad that you mentioned economic data because we will be paying attention to that jobs report coming out next week. We also get other employment figures next week, including JOLTS as well as ADP and a handful of ISM figures as well. So what are you looking for, especially since you highlighted that dual mandate from the Federal Reserve? We have to keep in mind that we will be getting more inflation figures as well as we head into the new month.
So regarding the Fed, I think we're going to be watching, obviously, the job data and all inflation data, which is what they're looking at, PCE. They did note today, Warsh did note today that data did get better, but they're not clear yet that it's moving on a sustainable path. So obviously, we're watching what the Fed's watching, and that will really imply the probabilities around what the Fed does. I do think if the CME is predicting a 70 to 80% chance of a hike, it is likely that it'll be already in the markets, and it'll be easier for the Fed to potentially hike in September. That being said, as of today, we still don't believe we're going to get a hike in September. But we are watching all the critical data between now and the Fed meeting to really to be confident on that Fed decision and what they'll do in mid-September.
Yeah, and based on what we could expect heading into the final quarter of 2026, the September Fed meeting is coming up on the 16th. But what are you watching between now and the end of this year when it comes to monetary policy?
Well, regarding monetary policy, obviously we're watching what the Fed cares about and what and what the Fed does. Obviously, we don't think they're going to want to be raising if the economic data weakens too much. So that's why the data is so important that we'll see over between now and September 16th, which is the date of the next Fed meeting, to imply what the Fed can and can't do. We also, at the same time, interestingly, as we're all aware of, the Treasury is looking to potentially be buying the long end. So we have kind of a counterbalance where the Fed may be raising rates and the Treasury may be buying the bonds at higher yields. So it's going to be interesting to see how that unfolds into the end of the year. But as long as the economy is resilient, which would mean the Fed can raise if they decide to, the market should be really strong going into the year. We see S&P 500 year end around 8,100, as I mentioned, primarily driven by just tremendous broad-based earnings growth.
Well, Brad, we will have to leave it there, but thank you so much for joining us on this Friday afternoon. I appreciate your perspective as well as all of your insights.
Thank you so much.
And now let's take a final look at the broader markets. Right now, we are looking at the Dow Industrials and we are looking at the chart in